So just for clarification, say somebody's selling a company for $30 million, pretty much all going to be zero cost basis. They've had the company for 50 years. They're able to sell the company, then put money into this trust and then not pay the taxes, or just basically, obviously they pay, but just defer the taxes for down the road. Is that what you're saying?
It makes me think about the biggest frustration with the 1031 exchange, right? And capital gains tax deferral for a lot of our clients who are in investment real estate and overpaying for properties. And that's what happened in the 2008 crash, 2005, 6, 7.
Saw that.
You know, they love being a seller, but they hated being a buyer, but they felt like they had to make the decision to purchase because they had a 30 to 50% in cap gains tax and depreciation recapture. And so they rolled and rolled and rolled. Music stopped, and some people lost half, some people lost all, some people had to crawl their way out over the next 5 years.
So true.
Because they had too much debt, not enough liquidity, not enough diversification. Now we found a solution to that. It's called the Deferred Sales Trust. What's unique about it is you can sell high, and then you can diversify into stocks, bonds, mutual funds. You can put it back into passive or active real estate. You can do hard money lending. You can start a business with it, all tax deferred, without having to take on debt, without having to do any rush shotgun weddings, right? We call it the 45-day engagement, 180-day wedding, because that's what the 1031's timing restrictions have, whereas the Deferred Sales Trust has none of that. So I'm curious, Rocco, have you ever heard of that before? Or any thoughts on being able to sell and diversify at these high prices?
I really like this strategy that you're talking about. I'm not familiar with it. I've heard of 1031 exchanges. I've heard of opportunity zones, but the actual trust itself, I'd love to learn more about myself. So just for clarification, say somebody's selling a company for $30 million, pretty much all going to be zero cost basis. They've had the company for 50 years. They're able to sell the company, then put money into this trust and then not pay the taxes, or just basically, obviously pay, but just defer the taxes for down the road. Is that what you're saying?
Exactly what I'm saying. It's precisely. And so we actually just did a business sale for an owner out of Alabama. He sold a $2.6 million business, and he had two partners who wanted to buy him out, and he had zero basis. And so it wasn't eligible for a 1031 exchange, first of all. And he wasn't ready and willing and able to really want to give it to all the way to charity. So he used the Deferred Sales Trust. We like to say it's like the CRT, except no C is required. He parked it into the Deferred Sales Trust, and then he has used some of the funds to partner with him on a deal to build 70 multifamily units in Tennessee, all tax deferred. So now some of the funds are stocks, bonds, mutual funds. Some of it can be in insurance. We like to just help the client with the financial advisors that we work with. My role as a trustee, we work with financial advisors like you, Rocco, across the U.S. A based upon their risk tolerance, a wealth plan, but it's a tax deferred wealth plan, right? And it can solve a lot of challenges. But you're right. For the gentleman who's selling a $30 million asset, they're looking not only at capital gains tax, but they're also looking at estate tax challenges. And so we're also able to use the Deferred Sales Trust. We call it 2.0 DST, to move it outside the taxable estate. And that's powerful too, because the growth of that is also outside the taxable estate. So it's been going around for 25 years. I wish I would have learned about it earlier than 2009. Unfortunately, I was at Marcus and Millichap in 06 to 07, 08. I didn't know about it, and people were doing 1031 exchanges and overpaying. We wish we would have known. But now we know. We try to teach everybody. By the way, if you're listening to this for the first time, you can go to capitalgainstaxsolutions.com to learn more and get our free ebook. We also have a mastermind that happens every Friday. We just closed our first cryptocurrency deal about 60 days ago. We've closed 2 of those since, and we're talking all things Deferred Sales Trust, cryptocurrency, tax deferral, and ways to grow your wealth. But yeah, that's how it works, Rocco. It's pretty cool. We're pretty excited about it. And but any thoughts on that?
I want to learn more. I'd like to learn more. So yeah, I'd love to understand this a little bit better and see how. Now, I assume that these have been IRS tested and in the trenches and all that. Is that correct?
Absolutely. It's been over a dozen no-change IRS audits. It's been 3 formal audits. It's never been on an IRS watch list or dirty dozen. There is a private letter ruling All of those audits were no change audits. The biggest one was in California. It was a $125 million deal. And so it's batting 1,000 after thousands of closes. And the part of it, why it is, Rocco, and you probably know the tax code, it's IRC 453. It's just an installment sale. And so as a seller, you can carry back paper. Like, for example, that $30 million business owner that you might know who's selling, he could technically carry back 100% financing for a buyer. He's not going to pay tax on what he hasn't received yet. It's in a deferral state. The reason you don't typically do a traditional installment sale is A, he wants to sell the business and move on. B, he might have to foreclose on it. And this is where the Deferred Sales Trust is really unique, in that it becomes a third-party trust where he actually sells the property, the company, to the trust prior to the trust selling it to the ultimate buyer. And the cash goes to the trust, and the seller receives a promissory note. And it's set to pay him over time, slowly. And as it pays him, he pays tax, ordinary income tax on the interest payments. If he dips into principal, it's capital gains tax. And so that's the short answer, but he's no longer tied to the old asset. And now the collateral that's in the trust can be secured against multiple assets. Again, and you can dollar cost average, and we have to say you can put it into safe harbor. Because a lot of our clients, they've made their wealth, and they're part of the baby boomers, and they're going, look, I don't necessarily need more wealth. I need to preserve it. I need to, figure out a way to pass it in a responsible way through living trust and getting outside the taxable estate. But I feel trapped by this big business because of the tax, or this big public or private stock holding I have, or cryptocurrency, or it also works for big old primary homes that aren't eligible for a 1031 exchange. And so, yeah, again, that's what it works for, if that makes sense.
It makes a lot of sense, and I'm definitely excited to learn more about this. Now, any restrictions in any states or anything like that?
Nope, all 50 states. And it can also be someone who's not even a U.S. citizen. If they have assets that are subject to U.S. capital gains tax, it's even more powerful for them, because they typically only have a $60,000 exemption on the estate tax for non-U.S. citizens, whereas a U.S. citizen has 22 million married, 12 million single. So it's even more powerful for people who are outside the U.S. who own stuff in the U.S. But yeah, it works for all 50 states. And yeah, anyone who wants to learn more, they can go to capitalgainstaxsolutions.com.